Dear fourth grade students at the Department of Economics, this is our second recorded lecture for the module entitled Economics of Investment and Financial Markets. We are going to continue covering Chapter 3 of Michigan and Eakins 2012. Let's quickly resume the main points which have been covered in the previous lecture. There are four types of debt instruments. They are simple loan, fixed payment loan, coupon bond, and discount bond. These debt instruments are evaluated against one another based on the amount of each cash flow and the timing of each cash flow. This evaluation is termed as present value analysis. Moreover, we have introduced the concept of yield to maturity. Financial economists consider it as the most accurate measure of interest rates. Yield to maturity is the interest rate that equates the present value of cash flows received from a debt instrument with its value today. In other words, yield to maturity is the discount rate that sets the present value of the promised debt instrument payments equal to its current market price. The yield to maturity is the return an investor will earn from holding the debt instrument to its maturity date. We have shown how yield to maturity is computed for the four types of credit market instruments, and we have concluded that for simple loans, the simple interest rate equals the yield to maturity. Calculating yield to maturity for fixed payment loans is not easy and requires using either financial calculators or Excel financial functions. For the coupon bond, we have concluded that there is a negative relationship between the price of a coupon bond and its yield to maturity. For a 1-year discount bond, we have concluded that its yield to maturity equals the increase in price over the year divided by its initial price. Two main points are covered in the current presentation: the distinction between real and nominal interest rates, and the distinction between interest rates and returns. What we have studied so far is referred to as the nominal interest rate. So a relevant question might be, what is the effect of the inflation on the cost of borrowing? Real interest rate more accurately reflects the true cost of borrowing. However, let's differentiate between ex-ante real interest rate and ex-post real interest rate. Ex-ante interest rate is computed by subtracting expected changes in the price level, that is inflation, from nominal interest rates as shown by equation 1, whereas the interest rate that is adjusted for actual changes in the price level is called the ex-post real interest rate. It is computed according to equation 2. The ex-ante real interest rates are most important to economic decisions. Typically, they are what financial economists mean when they make reference to the real interest rate. To recognize the importance of taking expected price changes into consideration when making financial decisions, let's consider the following two examples. First, assume that you have made a 1-year simple loan with a 5% interest rate, and you expect the consumer price index to increase by, say, 3% over the course of the year. In such a case, the ex-ante real interest rate is 2%. Thus, by making the loan and at the end of the year you expect to have 2% more in terms of real goods and services you can purchase. Now, assume that the nominal interest rate is 8% and the expected inflation rate is 10%. Would you make the loan in this case? To answer such a question, you have to compute the ex-ante real interest rate. It is not surprisingly that it has a negative value of 2%. This implies that you will receive 8% more dollars at the end of the year. However, you will pay 10% more for goods and services. In other words, at the end of the year, you will be 2% worse off in real terms. This because you will be able to purchase 2% fewer goods and services. Therefore, we could conclude that when real interest rates are low, there are more incentives for borrowers to borrow funds and vice versa. In contrast, when these real interest rates are low, there are fewer incentives for lenders to lend funds and vice versa. The real interest rates are important since they are likely to be better indicators of the incentives to borrow and lend. They reflect how economic agents will be affected by what is happening in credit markets. Let's explain this point. Remember that in the previous semester, we have studied the module entitled Economics of Egypt and Arab Countries. In this module, we have discussed the consequences of low and negative real interest rates in the case of Egypt over the open door policy and prior to the adoption of the economic reform and the structural adjustment program. Now, let's reconsider these consequences, which are discussed in ICRAM 2006. First, over this period, both lending and deposit rates were kept low and remained mostly negative in real terms. These low interest rates discouraged enterprises from self-financing and thus lowered business savings. A World Bank study concluded that a major factor in the financial difficulties experienced by Egyptian public enterprises was the inappropriate financial base caused by the high debt-to-equity ratios. High debt-to-equity ratios were consequences of making debt artificially cheap. Moreover, low deposit rates had depressed domestic savings, especially workers' remittances. Furthermore, low and negative interest rates were accompanied by overvalued exchange rates. Thus, they made capital artificially cheaper and increased the bias towards capital-intensive projects. Given the extremely low energy prices, the result was suboptimal investment allocations, which stressed capital and energy-intensive projects while neglecting labor-intensive investments in agriculture and in the processing of domestic raw materials. The existing mix of exchange rate and monetary policy had produced negative real interest rates and encouraged investment in construction, especially of high-rise apartments and office buildings. In other words, these policies had made investment in non-tradables more profitable than in tradables. To conclude, they had given faulty signals concerning the decisions on investment and production. Now we are going to differentiate between the interest rate on a bond and the rate of return on it. Many people think that the interest rate on a bond provides them with all they need to know about how well off they are due to holding it. However, this is not true. What informs us about this is the rate of return on the financial security. The rate of return on a bond or any other financial security tells us how well an individual does by holding it over a specific time period. The rate of return is defined as the payments to the owner plus the change in its value. The change in its value is expressed as a fraction of its purchase price. This is shown by the equation below. Note that the first term, which is highlighted in yellow, represented the payments to the owner of the financial security, whereas the second term, which is circled by red color, represented the rate of capital gain on that bond or this financial security. The return formula in equation 9 shown in the previous slide could be rewritten using two separate terms. The first term is the current yield, which is the coupon payment over the purchase price, whereas the second term is the rate of capital gain, that is the change in the bond's price relative to its initial purchase price. Therefore, the return formula is expressed in equation 9, which tells us that the return on a bond is the current yield plus the rate of capital gain, as mentioned earlier. Let's consider example 3.7 in your textbook. In this example, you are asked to compute the rate of return of a bond given that this bond is purchased for $1,000 and sold for $800 1 year later. Moreover, it has a face value of $1,000 and a coupon rate of 8%. By plugging these numbers into the equation used to calculate the rate of return, we find that the rate of return on this bond is negative. More precisely, it is negative 12% over the specified period. In example 3.7, the current yield equals 8%. In contrast, the rate of capital gain has a negative value of 20%. Thus, the rate of return, which is the sum of both, has a negative value of 12%. This example tells us that the current yield is an accurate measure of the yield to maturity for the bond, that is the interest rate for it, but the rate of return on it can differ significantly from this interest rate. From example 3.7, we have concluded that returns differ from the interest rate. This is true especially if there are sizable variations in the price of the bond, which then produce considerable capital gains or losses. For further examination of this point, let's look at what happens to the returns on bonds that have different maturities when interest rates increase. Using the aforementioned equation 10, Table 3.2 provides the 1 year return on several 10% coupon rate bonds. These bonds are all bought at face when the interest rates on all of them increase from 10% to 20%. Key conclusions from this table are as follows. First, if you look at the last bond in this table, you find that if the time to maturity is the same as the holding period for a bond, then its return equals the initial yield to maturity. Second, for bonds whose terms to maturity are longer than the holding periods, an increase in interest rates is accompanied by a drop in bond prices. This drop in bond price results in capital losses. Third, the far distant a bond's maturity date, the larger the size of the price change associated with an interest rate variation. Finally, the far distant a bond's maturity date, the lower the rate of return that happens due to the rise in the interest rate. Table 3.2 shows that the prices and returns of longer maturity bonds react more dramatically to variations in interest rates. This could be recognized by looking at columns 4 and 5. In other words, for long-term bonds, prices and returns are more volatile. Thus, fluctuations in interest rates make investments in long-term bonds risky. Riskiness of an asset's return resulting from interest rate variations is termed as interest rate risk. For any bond whose time to maturity matches the holding period, there is no interest rate risk. An example of this bond is the last coupon bond at the bottom of table 3.2. In such a case, there is no uncertainty about the rate of return. This is because the price at the end of the holding period is already fixed at the par value. Hence, the return will be equal to the yield to maturity known at the time the bond is purchased. In the current presentation, we have made a distinction between the ex-ante real interest rate and nominal interest rate. The ex-ante real interest rate is derived from Fisher equation and it is calculated as the nominal interest rate minus the expected rate of inflation. Ex-ante real interest rate is a better measure of the incentives to borrow and lend than the nominal interest rate. The first is a more accurate indicator of the tightness of credit market conditions than the latter. Moreover, we briefly discussed the Egyptian experience of keeping real interest rates low and negative in real terms over the period 1974 to 1990. We conclude that the mix of monetary policy and exchange rate policy had given faulty signals concerning the decisions on investment and production. We have made a distinction between interest rate and the rate of return on a bond. The rate of return on a bond could be defined as the payments to the holder of this bond plus the change in its value that is expressed as a fraction of its purchase price. Numerical examples show that the rate of return on a bond can differ significantly from the interest rate on it. We find that variations in interest rates make investments in long-term bonds quite risky. It is worth mentioning that the sensitivity of a bond's price to variations in interest rates is measured by what is termed as the bond's duration. This issue is of crucial importance for managing financial institutions. However, it requires further readings and discussion. This is the end of our lecture. Thank you.